Okay, so we could be trading using this knowledge. We could be shorting here. In fact, if we believe the market has turned down, which I think it's pretty safe to say it has, because this is a big down swoop here, and this looks like a corrective sequence. All right, let me show you one more example. I'll pull up the US Treasury bonds. Now the Treasury bonds, 30-year bonds, it's a future. This is the December future, and it's one I do trade quite often. I don't really cover it in the emails, and maybe I will later on. But it usually has a negative correlation with the Dow Jones. In other words, if the Dow Jones, the stock markets are rallying, normally that's bad for bonds. And that's certainly been the case in the recent past. Okay, this is a 30-minute chart, only going back to about a week or so. Here's the recent high. We've had a rally up to almost record. I should think they are. I haven't looked in the past, but 142 here is a very, very low yield. And the yield, by the way, on the bond is inversely proportional to the price. So the higher the price, the lower the yield of the bond. So these are record low interest rates, and that's for a 30-year bond. That's quite noteworthy. Okay, so let's see what happens if we start drawing Fibonacci retracements from this significant high here. We've had a plunge down here. So let's do this. We will just squeeze it up a bit so that I think it becomes a bit more apparent. There we go. So if this is our significant high, we click on it because that's the earliest point, and we go down to this significant low here. We see from this low we've rallied exactly to the 62% level. Don't know whether you can see that. I wonder if I can show you in more detail. There we go. That's a little bit better. Okay, to that level, the 62% level, and bounce back down. So that would be an excellent point to short. It actually made another rally up, but it actually exceeded this high here. But look at the pigtails, as I mentioned on the example of the Dow. 3 pigtails, which meant that every time the market tried to get up above it, but was knocked back down 3 times, and you're out. Down she went. Okay, that's a pretty good illustration of how you can use these candlestick charts to give you some clues as to the direction of the market. Right, let's get rid of that. Now, the next significant move is this one here. But as you see, the market came down, but it did not, this low did not exceed this low here. So what we need to do is keep to our Fibonacci pivot points, the same ones as we had before. Let's see, it's a bit sticky. That's very sticky. I'm not able to close that gap up, I'm afraid. But anyway, I've got that point there, and we see the rally off here, just a little pigtail above the 62% area here. So obviously the market did not like this area here. Big, big resistance. A clue that the market was set for a fall. So there we go. The market is falling. Let's see if we can find any more Fibonacci retracements. Okay, here's quite a good one. This is interesting. We've dealt with that one. We've had a new plunge to a new low. Here's a bit of a rally. So up here, if you're trading in real time up here, you might consider that as a significant low. And where is the significant high that we can use? Well, I think that is the one. We've already bypassed that. That's the major one. This is the secondary one. So let's see what happens if we use that as our pivot point. And we've got our low down here. Sure enough, the rally crashed through the 23%, hit 38%. There again, some pigtails. I don't know if you can see that. I'll expand that for you. There we go. Some pigtails here, and a big down day, confirming that that was indeed solid resistance at the 38% level. Now, I will say this, with as you've seen with these examples, with Fibonacci, you're not often going to get an exact hit on the line and then a total rebound off that line. You're more often than not going to see this sort of effect here. So if you're actually following the market in real time, which I know a lot of you are, you can be looking at the fine scale. I'm using the 30-minute chart here, and I wonder if I can pull up the 15-minute. There we go. You could be looking at this action here in real time, seeing what happens around this level here, this area here, especially with regard to the momentum. Now, I'll cover momentum and divergences in another video, but this is something that you need to keep an eye on when trading around Fibonacci levels to give you a clue as to whether the Fibonacci level will hold or will not hold. Okay, let's get rid of that. I think there's possibly one more example in here. Look at this action here. This is quite remarkable, isn't it? It's quite spiky, the Treasury bond market. Right, let's yeah, here's the high. Right, let's go back to the actual high here, the previous high. This is a significant low here, some very choppy action. I want to know how high this is likely to go. So let's get the Fibonacci tool working. That's my high. That's my low, just about there. And I'll squeeze this up. There we go. There we go. Right away, we see that we had a massive spike here. Then we had another rally, another pigtail above the, I think that's the 62% level, that's right. And then another chance at it, came back down. It really is bouncing along this level here. This actually is not a Fibonacci level, based upon those pivot points I've used. But if you're trading around here, you would get a pretty good idea that if this point was broken, you'd say that would be the end of it. And sure enough, we had a massive retreat off of this level here. Okay, I think that'll do it for now. I'll have some more advanced methods for you in another video. I hope you've enjoyed it and I hope you found it useful, and I'll see you in the next video.